I think what both gold and Bitcoin are reacting to is the increased knowledge on the part of a lot of people around the world that the US fiscal situation is just very, very out of control. And that even though the Fed hasn't formally pivoted, which is normally what it would take for these sound money assets to move higher, the fiscal situation suggests that it's only a matter of time until they will be forced into pivoting. And therefore, gold and Bitcoin are saying, oh, well, why wait?
Well, the Bitcoin halving finally happened today on the 19th of April. What does this mean for the price of Bitcoin going forward? We'll be going over the outlooks of Bitcoin, gold, the stock market, and the state of the economy, and what the Fed may do next with our next guest, Lawrence Lepard. He is the managing partner at Equity Management Associates, and he invests in both gold and Bitcoin, so he's well positioned to be talking about both of these assets. Today's episode is sponsored by NordVPN. Lawrence, welcome back to the show. It's been a while since I've had you on. It was like November, I think, the last time you were back on the show. So welcome back. A lot has happened since November 2023.
Yeah, it sure has. Thanks, David. Very nice of you to have me back. I always enjoy your show.
Thank you.
As we were discussing before the show, I kind of blew the call. I thought we'd be in a recession by now, and that really hasn't happened. The economy just keeps marching on, and partly it's because the federal government is spending like the true drunken sailor that they are.
Yeah.
As we discussed, I mean, the U.S. federal debt went up $1 trillion in 100 days. So if you annualize that, that's 3.65 trillion in a year. And that's a lot of money that continues to fuel the economy. So stock market has gone on to higher highs and so on and so forth. I think that the other big change that's occurred since you and I last spoke, and it's really quite meaningful, is that and we were talking about, I think in the last time we spoke, we were talking about, well, the Fed is going to have to pivot. They kind of had started to do that. As you recall, the 10-year went above 5% in October. They quickly came out with a bunch of Fed statements, said, well, the rate hike cycle is over. And of course, that jawboning got the 10-year back down underneath 4. And because they could see that if it was going through 5 and going higher, that was going to be a problem in terms of funding costs. So that occurred. But then, the new year opened up, and what, probably the most significant thing that occurred is the breakout. Well, the price of Bitcoin, is up 60% plus in the first quarter. We're now in mid-April, and the price of gold broke out to new all-time highs. I mean, the all-time high in gold, as we all know, had been kind of in the 2070 range, $2,070 an ounce. It bounced up against that a number of times, 3 or 4 times during the last 3 years, and then it decisively broke through it. And we're now, as you know, in the 2,400 area. 23, 24, but that's a clear breakout, no doubt about it. We've got an all-time high in gold, and I think what both gold and Bitcoin are reacting to is the increased knowledge on the part of a lot of people around the world that the US fiscal situation is just very, very out of control, and that even though the Fed hasn't formally pivoted, which is normally what it would take for these sound money assets to move higher, the fiscal situation suggests that it's only a matter of time until they will be forced into pivoting. And therefore, gold and Bitcoin are saying, oh, well, why wait? Let's get ahead of it. And so they both run. I mean, Bitcoin hit an all-time new high in the low 70s, and then it's backed off a bit since then. But gold is pushing right up against its all-time high as we speak. So that's the big change from the last time you and I spoke.
Here's the contradiction that I think is apparent in the economy, right? So
Yeah.
what we're seeing right now is the market's pushing back the possibility of a Fed cut by as late as 2025, I've seen. Certainly
Right.
the CME Fed Watch Tools projections for a cut this year are much lower in probability. But if you're saying we're going to get fiscal spending continue, in other words, in your words, the government spending like a drunken sailor and inflation is going to return as a result of that. Well, if inflation is going to remain high as a result of fiscal spending, I think you know where I'm going with this. Why would the Fed pivot if inflation is going to stay high?
Well, I think that's right. I think there's a chance they won't pivot until they're forced to, and until something breaks. And then what breaks might be the bond market. And there are different ways they can deal with this. In my most recent quarterly, we wrote about the ISDA letter, which is the Investment Securities Dealers Association, wrote a letter to the Fed saying, we want you to remove the SLR, supplementary leverage ratio restriction on all the banks, which would allow the banks to buy the debt. I mean, David, the underlying problem here is that the federal government is spending like crazy. They're using debt to do it, and they're having to continually adjust the debt. They're unable to sell long-term debt because everyone is aware, or more people are becoming aware of the duration risk. So they're trending towards selling more short-term debt, and the market's having a hard time taking it. And we can see this because the dealers are being forced to end up with more and more of these auctions. They used to get taken away by other bidders, but at the end of each auction, more recently, we've seen the dealers end up holding the paper. And this is what led to the ISDA letter. And, I think what's going on here is the world is waking up to the fact that inflation is not transitory and that we're not going to be able to get back to 2%. I mean, my most recent letter talks about this. If you look at the wage inflation, it's running closer to 6%. And as I put up on Twitter, I think last week, if you look at the reported inflation versus real inflation, there was a great chart that showed the cost of fast food pricing over the past 10 years and how much it had gone up, and it compared it to the CPI. And even the CPI, I think most people would agree, is really not accurately stating what their inflation is. I mean, CPI is reporting around 3, and everyone's, the Fed and others are saying they're going to get it down to 2. Well, how does that fit with, gas prices that are now up 18% this year? And I know many cases of insurance people, insurance costs of auto insurance up 20 or 30% year over year. You're seeing the wages are up 6% year over year. I mean, my contention has always been, when the 2020 COVID event happened and they printed all that money, we entered an inflationary world. And history shows that when you're in an inflationary world, it's not easy to contain it. And so I think we're going to have waves of inflation similar to what occurred in the 1970s.
We're going to continue with the discussion on the federal debt and fiscal dominance, as well as Lawrence's outlook on Bitcoin and gold in just a bit. But first, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Well, let's talk about that. 1970s was an era where we had a lot of geopolitical tension as well.
Correct.
A lot of parallels to today, actually. The oil shock in the 1970s propelled inflation to where it was today. Any similarities to what's going on today as we see oil spiking up as tensions in the Middle East ratchet up?
Certainly, that's one of them. I mean, that's a parallel. I mean, the oil shock in the 70s was even more severe because when the Arabs did the embargo, I think they tripled or quadrupled the price of oil. We haven't seen that. But yeah, history rhymes, correct? I mean, there certainly are a lot of tensions in the Middle East. The other thing that had occurred in the 70s is we had just gone off the gold standard in 71. And so, it was a time where I think, and the price of gold reacted to that and went up quite aggressively. And, the price of gold and the price now, Bitcoin didn't exist back then, but the price of gold and the price of Bitcoin, these two kind of represent the canaries in the coal mine, and that's why, as I said earlier when we were in the conversation here, gold breaking out to a new all-time high is a very important development. It's a very important signal that, that gold smells the coming inflation that we have. And you can see it in agricultural commodities too. They're going up quite sharply. So the price of oil recently has been going up, and that's, as you mentioned, on the tensions. But no 2 decades are the same. I mean, this is not the 1970s. They're different. It's a vastly different economy, but they rhyme. And inflation is hard to stop once it gets going because it gets into the psychology where, these wages going up 6%. That's because you've got employees who are saying, hey, everything I buy costs more. I need a higher wage. And it's a tight labor market because the economy is actually doing reasonably well.
Is the economy doing well, Lawrence? I've
I,
heard conflicting viewpoints, so I want to
yeah,
get.
that's a great question. I mean, I think it's mixed. I think for the upper middle class, it's doing fine. I think for a lot of people, they're really hurting, and it's kind of a mixed bag. And the employment numbers show that we're doing reasonably well in creating jobs, but a lot of them, some of them are government jobs, a lot of them are part-time jobs. I mean, I think it's a glass half empty or glass half full, depending upon how you look at it. I know that in the bigger cities where people have decent incomes, I'm in Naples, Florida, which is a fairly well-to-do area. The restaurants are jammed and there seems to be no recession at all. I also travel to areas of the country where, they're much less, affluent, and they seem to be hurting quite badly. So I think you've kind of got a two-tier economy going on. But, if you look at the aggregate numbers, I mean, we haven't clearly fallen into a recession. We might be bordering on the edge of one, but the aggregate GDP numbers still suggest small levels of growth, and I think they're accurate.
Yes, I know gold hedges against inflation, or some would say that it does long term. But how
Yeah.
much of the gold price is really just factoring in geopolitical risk right now, which, as we know, doesn't usually last?
Yeah, that's really tough to tease out. I mean, there's certainly a piece of that going on in the Middle East, but I think we should talk, if we're going to talk about the gold price, I think it's really important to talk about the demand that's coming out of China because, and I talked about this in my quarterly letter. We show a chart in there. I mean, one of the things I find very interesting is that the largest gold ETF, GLD, is actually shrinking in size, which suggests that North American investors are selling, on balance, selling gold. I mean, this ETF is getting smaller. And yet gold is going on to record highs. And why is that? Well, also in my quarterly, you could see a chart that shows that China has really stepped up their purchases of gold at both the government level and at the individual level. And I think China's been encountering some economic turbulence in terms of their economy, in terms of their real estate, in terms of their stock market. And so I think what you're seeing is a very strong bid. I think, well, one, I think that China at the governmental level is trending toward gold because they realize that the dollar as a neutral reserve currency is not as good as it used to be since the U.S. decided to seize the Russian assets. And I think that China at the individual level, people are realizing that real estate's not the investment they thought because it's not working, and perhaps stocks are risky, and so you see a lot of gold purchasing. So to me, and I'm not sure really, I don't think that kind of purchasing is driven by, drones in the Middle East. I think that's just pure, what's going on in their economy. And remember, China's an enormous economy. I mean, you're talking, a billion people, right? A lot bigger than the US. So to me, that's kind of the gold story. And the other place where you can see it, it's very interesting. It depends on which exchange you use over there and what you look at. But if you follow all the gold Twitter people and the ones who are looking at China carefully, lots of various ways of purchasing gold there are trading at premiums over melt value, which suggests to me that there's really strong demand to get a hold of gold, even if they have to pay a little more than melt. So that too supports the kind of this demand is coming from China side of things. And finally, I'll just add the Luke Gromen thesis that you're starting to see all these BRICS countries, and we've added a lot of countries to the BRICS. You're starting to see all these BRICS countries denominating their oil purchases in their own currencies, as opposed to the U.S. dollar, the petrodollar. And so that leads to yuan paying for oil, and the yuan being a currency that's getting accepted by the oil producers. And if those oil producers don't have things they need to purchase from China denominated in yuan, well, they might think, hey, okay, fine, I'm not sure I trust the yuan. I'll just swap it into gold. And it's easy to do with the Shanghai Gold Exchange. So you're really kind of seeing a changing of the guard, I think, in terms of what it is the neutral reserve currency. And it always used to be the dollar, but that's kind of, and that's not going to disappear overnight, by the way. But the trend is in a direction that's away from the dollar. We can clearly see that.
Just on the note on gold ETFs, you're right. There's been net outflows for the last couple of months. Interestingly, though, most of the outflows have been coming from Europe and North America,
Correct.
cushioned by inflows from Asia. Just last month, the outflows softened a bit, but the point still stands. Why do you think Asian investors are rushing into gold more than their North American and European counterparts?
I think it's just the knowledge. I mean, they tend to be a little bit wiser about currency crises because they've had more of them and they've seen more of them and they understand the issues. And so I think it's that knowledge combined with, as I said, maybe their investment alternatives aren't looking as attractive as they used to. I mean, I know the Chinese were large buyers of real estate and speculators in real estate. And my understanding, and I'm not close to it, I'm not on the ground, but my understanding is that the Chinese real estate market has been very soft and is problematic. And so I'm thinking people are thinking, well, we're not going to chase that because it's not working. Meanwhile, gold is working. I mean, gold is up significantly. And so they're more likely to chase it.
Bitcoin, then. Let's talk about Bitcoin
Ah,
before ultimately your market outlook. Bitcoin is an interesting asset. It's been moving alongside gold, but more so moving alongside still the NASDAQ. It's taken a bit of a breather since its highs of $73,000, now trading back to $64,000. What's next is my question. Intermediate term and I guess long term.
boy, it's a wild animal and nobody can really know. I mean, long term, I'm highly confident that it will continue to outperform and be much higher. And by that, I mean by the end of this year, next year, the following year. Short term, it could do anything it wants. As you know, it's quite volatile. I think what's going on in Bitcoin is just the knowledge, very much like gold. I mean, and I do consider, I mean, gold is 5,000-year-old money, it's the soundest form of money ever until Bitcoin came along. And it's analog sound money. Bitcoin's digital sound money. And I think that what's going on there is you're just seeing more and more people becoming aware of the fiscal and debt problems that the world has and looking for an escape hatch. Gold's one and Bitcoin's another. Turns out Bitcoin has performed better than gold. So, younger people tend to aggressively go towards Bitcoin. But as you point out, it has been correlated with the NASDAQ. It has been correlated with risk on, and it does tend to have pretty wide swings. And so it's not suited for everybody. There are people who, prefer not to have the volatility and they might, and they're looking for a sound alternative. They might choose gold. In turn, if you're looking for the most rapid growth on a performance basis, Bitcoin has clearly been the better choice for the last 10 or 15 years, and I think it will continue to be a better choice. So, but it's come along too. And I mean, to me, as I said, I think earlier, these are both the canaries in the coal mine. The fact that they are both up as big as they are, Bitcoin's up 66% in the quarter. Oh my goodness, that's a big number. Gold was up now 13, 14% in the quarter. That's a good number too. Just annualize those are huge numbers. I mean, so something's going on here. The fact they're both up together and the stock market wasn't up that much. I mean, something's going on here. And what I submit is going on is a larger percentage of the world is becoming aware of the monetary problems that are about to emerge because the Fed is trapped. And I think at the end of the day, they can say they're going to go higher, they can say they're going to go lower, they can talk all they want, they can jawbone, they do all kinds of things, they lie about what they're doing. But at the end of the day, if push comes to shove and the choices are do nothing and let the system collapse, or print money and create new programs to accommodate the system and dilute the value of the dollar through debasement, the politicians, they will always choose option two, because as we saw in 08, in 2020, in 2019 with the repo blowout, in March of 2023 with Silicon Valley Bank, they are not going to let the system collapse. Full stop. They can't. They just won't do it. But what makes it so hard for all of us is they tend to, in the interim periods, they tend to talk tough and, imply that, oh, they've got it all under control and we're going back to 2% and da 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 da. But, again, I think what's going on is gold and Bitcoin are saying bullshit. You guys can say all that stuff. Yeah, we hear you. That's what you're saying for sure. But you know what? Bullshit. We don't believe it. We'll take the gold and Bitcoin. Thank you very much.
I want to learn more about your intermediate and long-term Bitcoin thesis. First, let's talk about the halving today. Why didn't the price move up?
Well, the halving again, it's at the end of the day, the block reward, whether it's 6.25 or 3.125, I mean, it's the difference between 900 Bitcoin a day and like 450 Bitcoin. It's not that's not the biggest determinant of demand, in my view, of supply and demand in the market. That's a small number compared to the 19 million coins that are out there. It has an impact, and historically, there's always been a price run after a halving, if you look back historically. So I fully expect we will have a price run. But if you actually also look back carefully, you'll see that in some of the prior halvings, it actually went down for a little bit before that price run began. It took a while. There was like a lag effect for the halving to have an effect on the price. And so it's entirely possible to me that that would occur again in this particular time frame. As I said, Bitcoin's a wild animal, and you just don't know on any given week, day, month what it's going to do. I mean, it could go to 50, it could go to 80. I mean, I have no idea. I will say this. I will say this though. I have great confidence that in a year or two, it's going to be much higher than it is today.
Okay, well, let's talk about price outlooks for both Bitcoin and gold. So I'll just ask you to evaluate some other outlooks that have been
Sure.
given. Standard Chartered Bank, let's start with Bitcoin first. Standard Chartered Bank upgraded their Bitcoin forecast last month. End of year, $150,000, and by 2025, $250,000. Can you evaluate 150K by the end of the year? Is that possible for you?
I think it's entirely possible, but I don't think it's a guarantee. I mean, so I agree that the ETF launch is a really big deal. I mean, it allows a huge pool of capital that could not easily buy Bitcoin to now buy Bitcoin. So, I mean, to be honest with you, I'll give you the spread. I mean, to my way of seeing end of calendar 2024, we could be at 100, we could be at 300. I have no idea. I doubt we're below 100. I highly doubt that. That's, from 60, that's a 40% move or a little higher. That should be pretty easy, 50% move. That should be pretty easy from here. To their number of 2025, 250, yeah, that sounds possible. It's very hard to know. It really is. And there are a lot of models, there are a lot of ways of looking at it. I look at them all, I weigh them all, and then I say, you know what, it's a new thing. I think Michael Saylor said all your models are broken. I think he's kind of right. We just don't really know how it's going to behave. I mean, it would not surprise me at all if it shot up to 250 quickly, but it also wouldn't surprise me if, a year from now we were only at 110. I mean, it's just, you just don't know.
Well, if you're expecting Bitcoin to go up either by, 20, 30, 40%, 60%, who knows exactly? Are you then also expecting the NASDAQ and the S&P 500 to continue going up?
Well, see, yeah. So one of the things I think a lot of people have said they're very correlated. And if you look backwards, there has been a certain amount of correlation. It trades like a risk asset, but I do believe that over time that's diminishing. And I think over time they will completely separate, where you could actually have the NASDAQ not doing well and Bitcoin doing well. But Bitcoin's a measure of liquidity, and the NASDAQ is tied to liquidity as well. So it's going to take time for the two to separate. But I do believe over time they will separate. But if they print a lot more money, I mean, my new base case, I've kind of revised this. I used to think we were going to have quite a big market downturn and quite a big recession. I'm actually, and maybe we will, I'll be wrong again, but I'm now, based on what I'm seeing, I'm now kind of starting to think, you know what? We're actually not going to have that big a downturn, that big a recession. We're going to have a pretty hot economy. It's going to be pretty healthy. The stock market could go higher. There'll be a lot of good things happening, with one exception. We're going to have serious inflation. Because they're going to have to grease the monetary skids. The velocity is going to pick up, and with those changes, there's no way you get out of this inflationary trap. And so it's entirely possible that the Fed ultimately starts thinking maybe they have to hike rates further. I don't know that they'll do that, but as you pointed out earlier, they've certainly backpedaled from a lot of rate cuts to very few rate cuts based on the strength of the economy. And so the new data that we all have, because we kind of all thought there's got to be a recession coming here, and there hasn't been in a big way yet, right?
Let's talk about what not to invest in during an inflationary trap. So when
Right.
inflation gets serious, what gets wiped out first?
Bonds, especially
I was
long
just thinking
duration
that.
bonds.
Yeah. Okay.
Yeah. So I mean, if somebody, I think Luke Groman used the term, who's the sucker at the card table? It's the bondholders, right? I mean, look at the TLT, which is the 20-year bond ETF. I mean, I think that thing's down 40 or 50% from its all-time high a few years ago. And sadly, I think it's going to get worse. So, you just in an inflationary environment, if you go back and look at the 70s, you wanted to own oil, you wanted to own gold because they both benefited from inflation. You did not want to own bonds. Henry Kaufman called them certificates of confiscation.
Speaking
So,
of bonds, what's your view on long-term yields? If you look at the 10-year and 30-year, 40 years ago, back in the 80s, they were near double digits, both. Well, mid
right.
mid single digits or near double digits. However, it troughed around 2020, 2021. Now it's on its upswing. Do you think we'll return to the peaks of the 1980s?
I do. I think we could. I mean, if inflation does what I think it's going to do, the only way bondholders are going to be willing to hold bonds is if the interest rate is higher. Now, I say that, and then I'll add a caveat. And the caveat is, I think at some point the Federal Reserve steps in, realizing that if they let interest rates get too high, um, you know, everybody and their brother is going to be bankrupt, including the federal government. I mean, the federal government kind of is bankrupt, but it'll be obvious that they're bankrupt. And so what I'm describing, of course, David, is yield curve control. So I think that as inflation starts to become more evident to everybody, the bond yields will start to go up. But I think there's a point at which the Fed will say, we can't allow this to get worse. And so we're going to start buying the bonds. We're going to reinstate QE and start buying the bonds and putting them on our balance sheet. And we're going to fix the interest rate at a certain level, that we're not going to let it go above that level. And that'll lead to a lot of balance sheet growth. That'll lead to a lot of monetary expansion. And of course, it'll make inflation worse. But that's what they will do, because the alternative would be to let those interest rates go up very, very high and choke everything off, and we would have a big crash. And keep in mind, the politicians are always looking to do, they don't think in 10 and 20-year timeframes what the right move is. They think in terms of what can get me elected next year. Who cares what happens after that, right? And so if their choice is have a big collapse and take the pain in order to reset, or kick the can and the inflation's a little bit higher, they always lean on, they'll take the kick the can, but inflation's going to be higher. So that's my prediction that I have a high degree of confidence in, is that we will have higher inflation.
Higher inflation and higher yields as a result.
And therefore higher yields, unless the Fed
Okay.
steps in with the yield curve control.
What do you mean the federal government is bankrupt?
Well, I mean, just, here's an entity
Yeah.
that has, tax revenue of $4.4 trillion and is spending $7.3 trillion and has debt of $34 trillion and has interest cost of $1.1 trillion going to 1.6. I mean, if this is a household, they'd be bankrupt. I mean, their expenses vastly exceed their income, and their debt is enormous, and they can barely service it. Their interest costs are going up, and they're having a hard time servicing their debt. So,
Correct. But in this example, I have a printer in my basement.
well,
And I
you're
print
absolutely
money.
right. You're absolutely right, and you're right, and therefore, I say it tongue in cheek, because as a practical matter, you and I both know they cannot be bankrupt, because they do have that printer, and on a nominal basis, they will always be quote unquote money good, because they can run that printer. Of course, taken to the extreme, if they run that printer too hard, it all becomes monopoly money, right? And everyone loses confidence in it. So that's the issue. But I mean, the point I'm making, David, is that countries like ours that have gotten themselves this deep into it, where they have this much debt and this big a deficit, it, generally speaking, I mean, Reinhardt and Rogoff in their papers and so forth have shown, it ends badly. I mean, either we're going to have a complete collapse, which I don't think they'll allow to happen, or we're going to have high inflation, which I do think they'll allow to happen.
Okay. We talked about the Bitcoin forecast. Let's talk about your gold forecast. Now, Citibank is projecting gold to hit $3,000 over the next 6 to 18 months. Goldman Sachs updated the gold forecast to $2,700 by year end. Lawrence, in your many years working in the investment industry, what does it mean? Do you know if it means anything if the large banks and brokers are very bullish on gold?
Yeah, no, I mean, I think it's a good thing, and I think it's a changing of the guard. I mean, so I'm pleased to see this, and my forecast is much higher. I mean, I think we're going to 5,000 easily, and then maybe 10 or 15, but that's years out. So let's stick within the next couple of years. I mean, I think it's interesting, and on my Twitter feed, you'll see, if you go back a few days, you'll see a Ronnie Stofferly chart, and it's actually in my quarterly report as well. the mean Bloomberg estimate for the gold price in 2027, I believe, was somewhere in the $1,700 or $1,800 range. So until, these new numbers you just pointed out from Goldman and others, the average Wall Streeter is thinking we're going to go back to 2% inflation. You don't need gold, and gold's going to come back down from this $2,300 to $2,400 level. I think that's starting to change. Obviously, Goldman is a smart shop, and they're saying they think it's going higher. And my sense is they're right. And what that will lead to is a difference on the part of a larger part of the investment community, to understand that gold is in a bull market. And typically in bull markets, when they get started, gold goes up, in the 70s, it went up 22x. In the 2000 to 2011, it went up, 7 or 8x. And in this particular one, it started at 1,050 in 2015, and it's at 2,400. So we're up, what, 2.2x or something like that. So, I think it's destined for significantly higher numbers from where it is now. And this is just the beginning. And as more and more people come to realize that, and more people come to realize that it's performing well, I mean, you know how Wall Street operates, you know how investment firms operate, they chase performance. And so, for a long time here, gold was stuck between 1,800 and 1,900, maybe 2,000 on the high end, a couple of days. There was no real performance. It was dead money for the last 3 years. Well, when you get a breakout to an all-time high, that wakes people up. And, now we've really rather quickly shot up 15-20%. And that's going to get people's attention. And so you're going to say, oh, a new bull market, great. Let me in on that. I want to buy some gold. So I'm quite bullish. Yeah.
I've talked to many gold miners, and understandably, the CEOs think their companies are undervalued. But you, as an investor, what do you think?
I agree with them. It depends on the company. Not all of them are. Some of the crummy companies deserve to be at the prices they're at. But I think as a general rule, they're correct. I mean, what's happened here, David, is everyone's looked at the gold price and said, when it was bouncing around between, 18 and 2000, and the ASIC, which is the all-in sustaining cost of mining an ounce of gold, that's gone up rather significantly since COVID came along. The cost of the fuel and the explosives and the labor, those costs keep marching relentlessly higher, so that we're now at ASICs that are closer to 1,350 as kind of an industry average. So, if the price of gold is only going to be 18 or 1,900, that margin is really starting to get squeezed. Now, as we now know, the price of gold is at 24. Well, that nicely restores that margin and the profitability of these gold miners. And I think the gold mining stocks have not woken up to the fact that, gold is much more likely to be at 2,700 than it is to be at 1,800. And I think once the gold mining stocks wake up to that fact, there's going to be a re-rating, and my fund and other people who've invested in gold stocks are going to do extraordinarily well.
There must be a reason for why the sentiment for miners has lagged behind the sentiment for the bullion.
Yeah.
I mean, I understand the central banks haven't been buying the junior miners, right? But
that's true. No, they don't buy
the.
Yeah. Well, it's also a tough business. I mean, to be fair, and as again, this is all in my quarterly report, so people should read that. But the people who were in this area in the 2012, 2013 area, they just got annihilated, including me. I mean, it was such a rough bear market from 13 to 16. And people haven't entirely forgotten that. And, and then 16, we had a bull market. And then frankly, from 16 to 18, we kind of had a pullback. And then we had a good year in, 19 and a good year in 20, but then we've had another pullback. So, we've been kind of slowly but surely. This reminds me of the stock market back in the 80s. Back in 1980, when I started in the business, you were crazy if you didn't own gold. You were crazy if you didn't own oil. You were crazy if you didn't own commodities, and nobody wanted to own stocks or bonds. Those were both terrible areas to invest. And of course, as it turned out, that was the beginning of a huge bull market in stocks and a huge bull market in bonds. And so, and they were good areas to invest in, and gold was about to do very poorly, and so were commodities. So, it's just people tend to invest in the rearview mirror. They look at what has worked, and so they tend to, I mean, right now, you've still got a generation of investors that think the stock market is clearly the best place to be, because since 2008, the US stock market, it has always paid to buy the dip. It has always worked out. no matter how rough the dip was, if you bought it, you eventually came back and went on to a new high. And so, the market's off a touch now from its high, but I'm sure there are people buying it thinking, oh, this is an opportunity and I know it's going to come back. And maybe it will. But, if you look at John Hussman's numbers or other historical people who do historical analyses, you look at their numbers, I mean, it's as overvalued as it was in 2000 or 1929. It's very overvalued. So I think that as the stock market rolls over, and I do think it will roll over, perhaps not crash, but just doesn't go up as much as has been going up, people, and meanwhile, gold is going up and gold stocks are going up. All that money that's in traditional stocks, and by the way, it's a lot of money. It's like $150 trillion in traditional stock markets worldwide. The entire market for gold and gold stocks is less than $1 trillion. Some of that money is going to say, you know what? I don't think I need these stocks as much as I need to own some gold stocks and I need to own some gold. And that's how bull markets get made. The people will transfer from over there to over here. And in my view, even though my fund was up 25% last month, but that's just a start. I mean, I think we're just getting going. I mean, if this is a 9-inning baseball game, we're like in the first inning.
You're a unique position to answer questions about gold and Bitcoin because you own
Yeah.
both. My
Yeah,
question
I
is,
do.
why do
I
you
love
own both?
I love
Why,
it both.
not a lot of gold investors own Bitcoin and vice versa, but you told me
Yeah.
offline they're both sound money. Why?
Well, mainly based on stock to flow. I mean, stock to flow is what Saifedean describes in his books as, the amount of money that's out there and then the amount of new money that gets created. And so there's a pile of gold out there, all the gold we've ever mined that's not on the bottom of the ocean is either around some woman's neck or in a vault. And, it's 210,000 metric tons of it. We add to that supply about 1.7% a year. Presently, Bitcoin has a hard cap of 21 million coins. We're presently at 19.6 million of them issued. So a large majority of them have been issued, but we still have a bit more to go. And until the halving, which literally occurs today, they were increasing the supply by about 1.7% a day through the miner reward. And of course, that'll be cut in half. So as of after the halving, the Bitcoin supply growth rate will go to 0.8% per year, making it sounder than gold on a stock to flow ratio. The reason in my opinion, they're sound money is that the government cannot print them. Gold, you can only get the old-fashioned way by breaking rocks and digging it out of the ground, which costs time and money. And Bitcoin, you can only get newly issued Bitcoin by running a Bitcoin mining operation that consumes electricity to do the proof of work to validate the chain. So they really represent, analog sound money as gold and digital sound money as Bitcoin. The reason Bitcoin, in my opinion, is likely to perform better on an alpha basis, is that they're both going to benefit from monetary debasement, which as I've described it, I think it's one of the things in life that's pretty certain right now that governments are going to debase the currency. But Bitcoin is also going through an adoption curve. And presently there may be 100 or 200 million people in the world who know what Bitcoin is and own Bitcoin, and probably more know what it is. Probably 100 to 200 million own it. And 8 billion people know what gold is, and a lot more own it. But as you'll see, if you look at any of the statistics, I mean, the number of Bitcoin holders, the number of Bitcoin addresses, all of this, it's growing at 20 or 30% a year. And so as that continues, there's an adoption curve effect that I think is going to, with a fixed supply, it's just going to push the price significantly higher.
So death, taxes, and monetary debasement, those are the certainties of life right now.
It sure feels that way. I mean, look, that could change, and I keep my eye on it. I mean, if suddenly we saw some real fiscal responsibility coming from these governments, that would change the thesis here a little bit, right? But gosh, you look at, I mean, the U.S. Congress just passed I think it was a $1.2 trillion bill. They gave their members about 48 hours to read it. Maybe a month before that, Biden came out with a proposed 2025 federal spending proposal that was $7.3 trillion, which represented a 13% increase over the prior year. So how do you grow the federal government spending at 13%? when your GDP is growing at 2.6% and have the numbers balanced. I mean, the only way to do that is by printing the currency to fill the difference. So, you know, it really is kind of, for those of us who've been in finance a long time and we're watching it, I kind of sit back and I'm kind of stunned that you know, what's happening is happening. But then you look at the political system and the way it's set up and how these people want to keep getting elected and how they're not getting punished for doing this yet. And so you can see why they keep doing it.
On that note, would your investment strategy change under a Biden presidency or a Trump second term?
It really doesn't. I think they're both bad in different ways. You know, maybe one's a little less bad than the other. I'm not going to say which, but you know, I think that, and the Congress is, you know, holds the purse as well. I think that Washington, D.C., you know, collectively cannot kick the spending habit that they've got. They just can't kick it, and it's a real problem. And I think it's both sides. I think it's Repubs and Dems. So, and we've seen that historically, by the way. I mean, you look back and they're both guilty. I mean, it's not like there's one responsible party.
Their fiscal policies wouldn't change, you think?
Perhaps at the margin, but no, I really don't think so, actually. I think they're going to be close to the same. You know, I mean, certainly right now, one of the things you got going on, and maybe it'll slow down post the election, is Biden is clearly trying to buy this election, right? I mean, you know, he just keeps, even though the Supreme Court has ruled against him, he keeps coming back at this forgiving student debt thing. I mean, it's just, he's trying to buy those votes, right? And this budget has got everything but the kitchen sink in it. Again, he's just trying to buy votes. And so, you know, this year particularly is going to be a really bad spending year. Yeah, it's possible that after this year and whoever gets elected comes back in and says, hey, you know what, we got to trim this stuff back. And that's entirely a possibility, but you know, so far, I don't see any evidence of it.
Okay, fair enough. You mentioned you have a quarterly report. Where can we follow your work?
Yeah, so I'm on Twitter under my name, Lawrence Lepard, making a lot of noise there. But more importantly, the quarterly is free. It's just a macro write-up on what we see going on in the world. You can go to our website. We've got the last few years up there. You can download it in PDF form. The website is EMA, Edward Mark Alpha 2.com. Equity Management Associates. If you Google it, you'll find it. And then if you put in your email there, you can sign up for a free distribution of that quarterly. We'll never spam you. And so every time we write that report, we just send it out to the entire email list, and so you can see it. And it's nothing more than what I've been talking about, but there's some really interesting charts in there that I think, you know, support the case I'm making for why the fiscal situation's a mess.
Well, Lawrence, we appreciate you spending time with us
Oh,
on
I enjoyed
Bitcoin
it,
halving
David.
day.
Yeah, I always do. I enjoyed it very much, David, and really appreciate what you're doing. I think you're doing a great job with your
Thank you.
channel. So
Appreciate it.
happy to help out anytime I can.
And thank you. I'm sure our viewers appreciate it as well. So happy to have you on anytime when there's a big market move. Plenty to talk about the coming months, I'm sure. So
Yeah.
we'll speak again soon. Thanks very much, Lawrence. Don't forget to follow Lawrence. The link's down below. And thanks for watching. Don't forget to like and subscribe.